Hi everyone, welcome to our September Market Outlook video. August was a busy month for markets. We saw sell-offs, we saw more indications of slowing economic growth. I'm Valerie Leonard, founder of EverThrive Financial Group, and I wanted to make sure that you knew what was going on with the economy and the markets. And so I'm here today to help you understand what you as an investor should consider to help protect and grow your money. At the end of August, the S&P 500 dropped about 4%. We saw the Dow Jones down about 3.7%, and then the NASDAQ was down about 4.5%. So this really was a tale of two Augusts. We saw a rally at the beginning of the month that was followed by a decline. And as you can see here in this chart, markets were pretty volatile overall. So what happened? Why did the month end down? The sell-off was primarily a result of news from the Fed in the month of August. So Federal Reserve Chairman Jerome Powell, he's shown here, he announced that the central bank planned to keep short-term interest rates higher for longer in order to help combat inflation. And since rising interest rates typically hurt stock market valuations, a lot of times this can lead to slower economic growth. Now, the Fed continued to reiterate that as long as inflation remains above its target rate, they are going to follow their aggressive policy of quantitative tightening. That's just a fancy word of saying that you can expect interest rates to continue to rise, and the Fed is going to remain focused on reducing its balance sheet. So they're sucking liquidity out of the system. So what does that mean for you as an investor, and what can you do to navigate these changing market conditions? Well, there's a few things that investors can do. Remember that sell-offs can mean upside, including the opportunity to buy low, depending on your investment time frame. Now, you already know some of the investment basics. We've talked about them in previous videos, like staying diversified, having a long-term view, and this is really where you can see those basics work. At EverThrive, we always have a plan to adjust our clients' investments within their risk tolerance anytime there's a market surprise, and this is one of the benefits of having an actively managed portfolio. For those of you that may have money in a 401k plan where we don't have discretionary management authority and you've got to make changes on your own, this is a great time to contact us to review your accounts and determine whether changes should be made, because it might be that the timing is right to do so. Another big change from earlier this year is the pace of home sales. You can see here that home sales have dipped from around 6.5 million, this is existing home sales, in January to 4.8 million in July. So keep in mind that some of the slowdown was expected because we saw the pandemic created this flight to the suburbs, and that reactionary demand has tapered off. But since housing demand is an important economic indicator, we're going to continue to keep an eye on this. Thankfully, demographics still remain strong in this country, and we expect that housing demand will continue at least for the next few years, but this is an important indicator to watch. In August, there were 315,000 jobs added to the economy, and we also saw average hourly earnings were up slightly. Basically, hiring remains strong, which is a good sign, but we still know that households are getting squeezed by inflation. So it's going to be really important to watch employment in the future, but I want you to keep in mind that this is a late cycle indicator. We often don't see employment decline until we're already in a recession. And this can be attributable to the fact that companies don't often lay off workers until their bottom line has already been negatively impacted. So we'll watch this one closely. We aren't out of the recession woods yet, so we're going to continue to stay vigilant when it comes to watching volatility. Now, from last month to this month, there were economic and market surprises, and we know there could be more unexpected news this fall. So we'll also be watching some contradictory and concerning data that we saw in the month of August, and we're already starting to see into September, such as waning small business, CEO, and consumer confidence. These are all really important things to watch. We've seen businesses reduce their spending, lower manufacturing activity. Of course, I've already mentioned home sales that are slowing, and then also a spike in credit card debt taken on by U.S. consumers. This at a time when interest rates are also rising. I wanted to mention that there are generally always opportunities in the market, like I mentioned earlier, even when things don't seem so great. So for instance, you may keep hearing about the inverted yield curve. Okay, so this chart from BlackRock shows how various sectors have performed going back to 1989 when the yield curve has inverted like it has now. So some sectors do poorly, others fare all right. So an example is technology. Typically, when the yield curve is inverted, it's down about 13.5%, whereas consumer staples up 12%, industrials and healthcare up around 6%, utilities up about 12%. So there's still potential opportunities out there, even despite the conditions that we're in right now. And additionally, you may be interested to hear that going back to 1929, the stock market generally performs well 1 year after a recession. So on average, the market was higher by about 24.5% 1 year later and 14.7% 3 years later. So this just reiterates the importance of not allowing your emotions to dictate your investment decisions. Time in the market is very, very important. As we head into the fall months, we'll make sure to keep you informed. If you'll click the subscribe button on our EverThrive YouTube channel, you'll be notified as soon as we post an update. And it may indeed be a bumpy fall, but we are always here for any questions you may have. So feel free to reach out to us for any reason. Thanks again for joining us here, and we will see you again next month.